This is David Ranson. Welcome to our webcast for clients month of January 2021. It's on a theme, explaining and predicting international investment results. Many of our clients miss the body of research that HCWE devotes to international markets. Like the domestic side of our work, it's empirically based and actionable. It's also profoundly at odds with the current academic conventions that dominate the media. For example, currency values are not an effective political weapon and do not sustainably affect trade imbalances, but they do supply a powerful and ubiquitous input for forecasting inflation, growth, and capital markets around the world. With the disappearance of the classic US business cycle, there will be less scope for domestic asset allocation bets than there used to be. But as currencies continue to fluctuate, the international sphere will provide much underutilized scope for interesting investment bets. While stable currency values promote national success over time, many of the most rewarding opportunities lie in regimes that are in transition from instability to stability. And we'll cover that in detail. What's true in domestic economics is generally true internationally. For example, economic vitality always results from the availability of capital and the risk tolerance that enables it to be put to work productively. As long as capital is unharmed, economies are highly resilient in the face of major threats such as the coronavirus. These principles are sound axioms for investment strategy, even when they are at odds with conventional wisdom. They are no longer widely taught, and institutional investors are missing out on a lot of opportunities as a result. Exhibit 1 demonstrates one of these classical truths. Market economies, even where highly regulated, snap back automatically and quickly from disaster. Especially in Europe, where shutdowns were carried to an extreme, economic rebounds have been proportionately stronger. Of all the variables that control the US place in the world economy, the value of the dollar is paramount. A fall in the dollar deters capital from migrating to the US from overseas. Lack of capital slows down the US economy and stock market performance. The effect is clearly visible in Exhibit 2, showing US relative to foreign growth in different currency scenarios. The US share of world GDP has declined when the dollar depreciated and risen when it advanced. We can also see that even with a stable dollar, the US has been losing ground. This is no doubt due to the irrepressible development of the emerging world, including China. The same natural forces that drive US performance govern other economies too. The right panel of Exhibit 3 illustrates the negative effect that currency depreciation has on growth in the emerging world. The left panel shows the dramatic rates of inflation that accompany this degradation. The positive growth-inflation relationship assumed by conventional economists is nowhere to be seen. Currency movements affect inflation in the developed world in essentially the same way. But the effect on inflation often takes more time to become visible than in emerging countries. That's partly because currency movements are mostly smaller. Over longer periods of time, the parallel becomes unmistakable. In Exhibit 4, countries whose currencies have performed the worst, Italy for example, appear at the top of the chart, where inflation rates are highest. The most stable currencies appear at the bottom, where inflation is lowest. In terms of currency depreciation and in terms of inflation, countries rank identically. The relationship between currency change and inflation is even more straightforward than widely recognized. It's seen best in the emerging world where we find the most unstable currencies. In Exhibit 5, to encompass the huge historical scale of currency instability, we have to use a ratio scale that spans more than 3 powers of 10. As the chart demonstrates, it's nothing less than direct proportionality. Convention assumes that causation runs from inflation to currency values. The Economist's Big Mac Index is an example of this belief that currencies can be predicted from inflation rates. But even the Economist has conceded that it's an unsuccessful strategy. This is easily explained if causation goes the other way, from currency change to inflation. This is what we not only believe, but we can easily establish. Central banks are a world in which interest rates are controlled, and therefore inflation should be controlled too. Since 1973, central banks have been happy to allow currencies to float and take no responsibility for the consequences of currency instability. But that world is an intellectual bubble and completely different from the observable world around us. As was recognized in earlier times, currency values control inflation, and in turn, the expected inflation rate drives interest rates. Exhibit 6 confirms that currency depreciation leads consistently to higher relative bond yields. The chief currency event over the past 6 to 8 months has been a rise in the euro versus the dollar and other currencies. That's consistent with a small fall in expected inflation in the Eurozone and a small rise in the US, UK, Japan, and other places. If so, that explains the contrast in bond market behavior in Exhibit 7. Since mid-year, Eurozone bond yields have been continuing to decline, while those elsewhere have been rising. Eurozone bonds have therefore outperformed bonds elsewhere. But there is a good chance currencies will stabilize, and then the divergence will end. We are able to use currency changes as a leading indicator to catch this back and forth in relative returns from the bonds of different countries. Nowhere is the role of currency performance more evident than in stock markets. Even a change in the dollar by itself has major effects on relative returns in different countries. Some countries outperform others following a weakening of the dollar, while others benefit from a strengthening. Emerging markets, for example, are classified in Exhibit 8 according to their relative responses. The dollar's performance is shown in terms of gold. On the left of the diagram, the dollar appreciates, and on the right, it depreciates. The diagram also shows another major factor simultaneously at work. Some countries benefit relative to others following a widening or narrowing of credit spreads, corresponding to a worsening or improvement, respectively, in the risk climate. And there are some countries in the middle of the diagram which are insensitive to both factors. Overall, the diagram is an excellent way of capturing the varied responses of stock markets to the flow of capital in or out of the US economy. But prospects for countries' equity markets depend even more decisively on how their own currencies behave. Markets in depreciating currency zones have a strong tendency to produce lower returns. Interestingly, though, it's not the amount of depreciation that explains market performance. It's the surprise part of the currency change, the component that's a departure from the pre-existing trend. And currency surprises can be either positive or negative. So the variable shown in the 4 scenarios in Exhibit 9 is the acceleration or deceleration of currency change. The chart demonstrates this relationship for a portfolio of 7 emerging equity markets. Returns are highest when these currencies perform better than expected, and lowest when they perform worse than expected. The link between currencies and relative equity performance can be the basis for a lucrative investment strategy. Driving the strategy is the fact that unstable currencies have a strong tendency to stabilize. In other words, currency surprises are not just random, but can to some extent be anticipated. A currency that has performed badly has a much better chance of producing a positive currency surprise, and ironically, a very stable currency has little or no chance of that. Exhibit 10 shows this phenomenon repeatedly on display during the past 2 decades. 9 equity markets are included: the US, Canada, UK, Japan, China, the Eurozone, Switzerland, Australia, and Sweden. The table shows the collective calendar year return from those 4 markets where the scope for positive currency surprise was greatest at the beginning of each year. Also shown is the return from the 4 markets with the least scope for positive currency surprise. Cumulatively, as you can see, the former 4 markets handsomely outperformed the latter 4 by an average of 5.2 percentage points per annum. Exhibit 11 shows the strategy in action during the extraordinary year 2020. It uses the US dollar as the benchmark for currency performance. In the prior year, the weakest currencies had been those of Sweden, the Eurozone, China, and Australia. Currency surprises anticipated for these 4 currency zones were, therefore, the most positive. The least positive or most negative anticipated currency surprises were those for Canada, at the bottom of the list, the UK, Switzerland, and Japan. Canada, the country with the strongest currency the year before, and therefore the most negative anticipated currency surprise, turned out to be the weakest stock market performer in the sample. The success of the strategy is measured by the fact that the first 4 markets outperformed the latter 4 by 11.6 percentage points, 17.5 relative to 5.9. In anticipation of the obvious next question, Exhibit 12 shows how the same set of 9 currency zones are ranking at the beginning of 2021. Thanks to its weak performance in 2020, the US dollar heads the list. Sweden, with the best currency performance in 2020, has swung to the bottom of the list. I'll be reporting back how the strategy worked at the end of the year. All of these are illustrations of the scope of our international research work. In broad outline, the service is to publish, at least on a quarterly basis, reports of new and updated research under titles such as the International Forecaster, the International Economy, and Economic and Investment Observations. In addition, we publish bi-monthly reports that monitor stock, bond, and currency market performance in the developed and emerging worlds. In these reports and elsewhere, we provide country-bet forecasts of relative performance in developed and emerging equity markets. New forecast strategies in currency and bond markets are also under development. All of this work fits with a classical and factually tested approach to macroeconomics, which is frequently contrarian and designed to be actionable. If you find this work interesting, I would be delighted to hear from you. My email address is rdranson@hcwe.com, and I look forward to hearing from you. This is the webcast for January 2021. Our next webcast will be in March, and I look forward to speaking with you again then.